Okay, so like I said, we decided that it is a good idea to do trade in the forex market rather than in a shop, because basically here we exchange cash with cash. Like, I give you another example. For example, you have the same amount, $100,000 today, and gold, 1 ounce of gold is $3,300. So you can buy 30 ounces of gold at this price with this amount of money. It's almost $99,000. And when the price of gold goes to $3,400, if and when the price of gold goes $100 up, you are going to make 30 times $100, which is $3,000 profit. It might happen in one day, it might happen in 1 week, it might happen in 1 month, it might never happen. But even if it never happens, let's say the price, it's very unlikely that the price stays the same for more than 2 days. But if even the market goes against you, which might happen in any other business, and it goes to 3,200 this time instead of 3,400, you will lose the same amount of money, and this time you will be minus $3,000. But you used only 3%. I mean, you will lose only 3% of your money. In the regular business, you can lose much more than that. And if you have the knowledge and if you have the patience to buy at the right time and wait until the price goes to where you want, you will make money. Actually, like I said in the previous example, this kind of business is much better than that grocery shop example that I can give you examples about factories and other things. For one simple reason. The reason is you exchange cash against cash, or cash against gold, or silver, or anything else. I believe even gold is better than cash. We will get into it later. But here, this kind of business, you are on the safer side. Now, the question is, if it is so simple and so easy, then why do people lose money in the market? I'll explain to you why. In the forex market, you will open an account with a broker. And this broker, you can ask them to give you leverage. Leverage can be anything from 1 to 1. Basically, it's not leverage, it's all your money. 1 to 2, and sometimes even 1 to 400, depending on your broker and your jurisdiction. So, this leverage is what kills you in this market if you don't know how to use it. Today, I will give you a very simple example. I will try to explain this leverage and lot sizes and how the brokers actually want you to use the leverage, and why they want and why they give you leverage, and how you lose money because you use the leverage without knowing what you're actually doing. The broker, when you open an account, They will tell you you can start with any amount, even sometimes with as a small amount as $300, sometimes even with $100. Now let's say you have $10,000. I think I have to change my market. You have $10,000 in your account that you created with a broker, and you want to start trading gold. All right. The first thing you have to understand is that when you open a deal, the first thing you have to decide is your lot size. What amount of gold are you buying? The brokers will measure that amount in lots. In gold, one lot is equal to 100 ounces. It means if you buy one lot, you are not buying 1 ounce, you are buying 100 ounces. And the value of 100 ounces is 100 times 3,300, which is $330,000. The broker will tell you that you can choose to use a leverage of 1 to 10 or 1 to 100. Even 1 to 100 is possible. Sometimes 1 to 50, sometimes 1 to 30. Anyway, now we assume you have $10,000 and you are using a leverage of 1 to 10. It means you can buy one lot of gold equal to 100 ounces at the price of 3,300, but pay only 10% of this value, which will be $33,000. Okay. If you place an order like this, you have 10,000 and your leverage is 1 to 10, you will need $33,000 you don't have. So you can increase the leverage with your broker and ask for 1 to 100. This time you pay only 1% of the value and you use only $3,300 of your money. All right. We increase the leverage and now we can buy one lot. The broker will be more than happy to give you 100. I will tell you why. All right. So you open the deal. You will have the entry price, the price at which you place the order, 3,300. Lot size, 1, means 100 ounces. And the moment you open the deal, the market is of course moving. Now you're lucky and the market starts going up. What happens here is when the price of gold goes up by $100 from this price, you have 100 lots, and for every $1 that the market moves up, you are making $100, and you can close your deal with $10,000 profit, maybe in 1 day or two. Looks great, sounds great. But what happens when the market goes down? If the market goes against you, you had $10,000 in your account. You used 3,000 $300 of your money to to place this order. So now you have a free margin of $6,700. It means if the market goes down by $67, your account balance will be zero. In the real world, if you had not used leverage, you would have been able to buy 3 ounces, not 3 lots. Don't confuse it. 3 ounces. 3 ounces is equal to 0.03 lots. So if you had not used the leverage, you would have bought 3 ounces, and in this case, you would have made $300, and in this case, you would have lost $200. You would have been not too rich, but you would not have lost your money. But because you decide that you, with your $10,000, you want to buy 100 ounces instead of 3 ounces, you will lose all instead of losing just 200. That is leverage, and this is the stupid way to use the leverage. Now, I will tell you, you have probably understood that why do the brokers give you leverage? They want you to use the leverage, and they have their own games to play, the market makers, the banks, the people who control this market. Certainly, it's not you and me. It's people who have billions of dollars. And those people have billions of dollars because you and me and retail traders like us are just too greedy. We use too much of this leverage, and we give this little money to the big boys. And millions of us lose this much money every day. And they become richer and richer, and we get into deeper and deeper troubles. So the market is good. This forex trade, here you can make money if you understand leverage, if you know the lot size, if you know how much, how big an order you're placing, what you should expect, and basically how not to over leverage. Is it stupid to use the leverage? No. You can use the leverage in a wise way with a lot of ifs and ands, which this is what we are going to talk about in this channel. But the first thing, this warning here, and the answer to the question that I had written here, why do people lose money in the market, is because they use leverage excessively and in stupid ways. Thank you very much for listening. In the future videos, I'm going to talk about over leveraging. I will go into further details. I will also talk about over trading, because over trading is also a reason that people lose money in forex trade. And then once this thing is completely explained, we will go into the technical analysis. We will talk about the techniques, the indicators, and everything that retail traders like us are using, and how these brokers are using the same techniques against us to collect this small amount of money that we have. But this it's $10,000, maybe for them is nothing, but when millions of people lose this small monies in one day, that's the purpose of these people. We are going to understand this. I hope I managed to make myself clear. And there's a lot of things. There are many more details that we have to discuss about this. Thank you very much for listening.